My name is Rushdi Siddiqui. I'm the global head of Islamic finance and OIC countries for Thomson Reuters. Before that, I was with Dow Jones Indexes for 10 years. So in effect, I've been in this space, Islamic finance, for the last 15 years. I would consider myself an accidental tourist in Islamic finance more than anything else. Being raised in America in a South Asian family, the emphasis is on education leading to being a physician or an engineer or a college professor. My father happens to be a doctor and I'm the oldest, so it was expected that I would be in this particular space, sort of carry the mantle and pass the torch on to my son, so on and so forth. Unfortunately, in college, I couldn't make it past through chemistry and physics, tough subjects. So, through the process of what it didn't work for me, I found out something that I happened to be good at, be able to explain to others, and lo and behold, 15 years of traveling the road, 35 countries. I sit today in Dallas in front of some very important people and getting an acknowledgement that others before me have contributed in this space, and I'm honored, honestly, to be here today. I can give you a philosophical reply and say Islamic finance is very subjective. It's much like trying to define love. But then let's put that to the side. Islamic finance basically culls down to two things. It's financing or it's investing. And both of them are linked to the real economy. Let's remove the Arabic terms and the religious terms and see what it is that it's trying to do. It's trying to intermediate from those who have money to those who need money, whether it's an individual, whether it's a corporation, whether it's a government. So at one level, it serves the same functions as conventional finance, but the rules of engagement are a bit different. I don't want to say it's ethical finance because it implies everything else is unethical. Okay, it is basically participation finance, where you are basically risk sharing and not risk shifting. So hopefully that sort of gives you a high level, macro oriented of what Islamic finance objective is. Obviously, quote unquote, the devil is in the details, and that's where we're trying to put things together in an industry that's only 40 years old. I think we've done well. I think we still have a long way to go, but we've arrived. I think it's a function of, let me use the word praying. Some people pray like this, some people pray like this, some people pray like this. You can't standardize one way of praying. So much like Islamic finance, it's been influenced by culture, whether it's Indonesia Islamic finance or Saudi Arabia, which has a more strict interpretation of Islamic finance. So one cannot expect a universal definition, though in the Quran it says interest is prohibited and trade is allowed. That's the basis. Once we start getting into the details of products and structures, those things are not codified in the Quran and not codified in the Hadith. This is where the work of the scholars come in, and the scholars are influenced by the jurisdictions and the mahd that they have been brought up in. It's very difficult to have 100% of anything. Okay, now when you're trying to impose faith and finance and expect universal consensus, I think the chances of achieving that today or even tomorrow is remote. So let's break down to Islamic finance to what statistics and surveys have shown us today. That there are 1/3 that are purists, right? They want to have this, they can sleep at night when they know that their money is placed in a compliant manner, that their financing is in a compliant manner. Then there are 1/3 that are pure seculars. They are indifferent for a variety of reasons, right? And then there are the remaining third that are fence straddlers. They do not want to be penalized for believing their faith. So if the Islamic finance products offer lesser returns or cost more, it doesn't make sense for them to participate in Islamic finance. They will participate in conventional finance. So the approach to each third has to be different. And once we understand that, then we have a customized approach to trying to reach this target market. One of the criticisms from the man on the street is the following question is, what's the difference? They believe that it's smoke and mirrors. It's just basically calling profit rate to interest. So when you have the masses talk about this, the approach has to be further refined. From where I sit in the area that I've been involved with, the important takeaway for me has been delinking or decoupling from conventional finance. Before we had Islamic indexes, the industry used social ethical indexes, right? So how can we have Islamic indexes? And so in 1999 at Dow Jones, we launched the world's first Islamic index by an index provider. Then in 2006, we launched a Sukuk index with Dow Jones Citigroup as an alternative to a bond index. In 2011, we launched the world's first halal food index, and also in 2011, we launched the world's first alternative index to LIBOR. So the point here in this exercise is to delink from conventional finance. The delinking starts from where I sit and what I do from indexes, because the indexes convey information or pulse of an asset class, of an industry. Once we have a better understanding that this particular number, whether it's a performance index or a pricing index, represents a pulse of Islamic finance, then we are starting the process of having true and real delinking, which sets up the foundation, a solid foundation for growth and development. Well, indexes, for example, people have heard of the Dow Jones Industrial Average or the S&P 500, right? If I say that this is how the Dow did yesterday, 2% up, then people have a mental picture in their head of how the U.S. capital markets did, right? For the Islamic space, there is a process that one has to undertake to remove companies whose primary business is in the impermissible sector. So banks, conventional banks, are not allowed because they deal with interest. And then there are the pork companies and the alcohol companies and the casino companies, so on and so forth. So what you do is you remove these companies whose primary business is what I just mentioned. So it's at one level no different than social ethical indexes, which is a function of negative screening. Islamic goes one step further and looks at the financial ratios of a company. It looks at debt, it looks at accounts receivable, and it looks at non-operating interest income. So you have two levels of screening, primary business and then the financial ratios. The net of all this is these are the preconditions to invest in the stock market, where it's in the G20 Western world or the Muslim world. Once you basically apply these screens on the stock market, it results in a subset of companies which are low debt, non-financial, social, ethical indexes. These are called Sharia compliant indexes. And they don't give you a pulse of Islamic finance because companies are like Microsoft, IBM, Pfizer, BP, Amoco, right? But these companies do not have Islamic in their bylaws or pay zakat. So this was the first stage of index and Sharia compliance. What we're working now on is on Sharia-based indexes, where you've got dedicated Islamic banks that are public listed, takaful or insurance companies publicly listed, or Islamic leasing companies publicly listed, so on and so forth. Companies whose bylaws basically say that it operates under the glorious Sharia. Second, it has a Sharia board. Third is it pays zakat. Fourth is it purifies impermissible income. So those companies in an index give you a pulse of Islamic finance at a country level and then at a global level. Well, on the Sharia compliance index, the market capitalization of the companies in this index is close to $17 trillion. So it's big. But again, the bulk of these companies are in the Western markets. There's very little exposure to stock exchanges in the Muslim countries because those are either frontier markets or emerging markets, right? So they have concerns about companies' free float, meaning the amount of shares available for investing, or countries may have restrictions, such as Saudi Arabia, of coming in directly for non-Saudis, for example. So today's Sharia compliance index at a global level, it may be 30 or 40 or 50 countries, close to 5,000-6,000 companies, is about $17 trillion. It's big. Now, as we look into Sharia-based indexes, meaning companies from the Muslim world who are involved in Islamic finance primarily, that's a much smaller universe. And there's still challenges related to investing in those companies because those companies may have a few shares outstanding or they may not trade well. But the process has started. It's still going to take time, but the more important thing is starting the process. To the layman, yes, it's analogous to the bonds. Basically, today Islamic finance is debt capital market heavy, right? Which makes sense because it's more risk averse. Today's Islamic finance, if we were to say it's $1 trillion industry, about $240 billion of sukuk are outstanding, and murabaha syndicated loans are about $100+ billion. So in effect, 35% of Islamic finance is debt capital markets. From the point of view of Islamic bonds, for lack of a better phrase, sukuk, right? They basically represent either asset-backed or asset-based in an underlying asset, which generates a revenue, which is then captured, and then profit rates are basically given to the holder. It is the beginning of having economies in the Muslim world move from bank financing to debt capital market financing. Unfortunately, people are expecting that the sukuk would take off and it would replace bonds in the Muslim world, and Western institutions are going to follow also because it's good and it's another source of financing. The challenge is regulations. Many of the Islamic structures require two purchase and sale agreements, so it's tax inefficient. For Islamic finance, by way of, say, sukuk, to work well, there has to be a level of the playing field. One aspect of the level of the playing field is on tax and on regulations. Some jurisdictions have recognized this, that have taxes. Others, it's still a challenge. So the point of what a sukuk is meant to do, it's basically a financing, whether it's for a corporate, a quasi, or a sovereign. It's an alternative to bonds, but the interesting thing is whatever the underlying asset is, the sukuk has to be linked to its value. So you won't be issuing a sukuk greater than the value of the asset, which is an important takeaway in light of credit crisis 1, credit crisis 2. You know what, besides toll roads, you've got hospitals, you've got government buildings that basically have tenants which have to pay an annual payment, so on and so forth. So at one level, there are hard assets in a country that the government owns that generate a revenue which can be captured by way of a sukuk. So that's fine because there's no casinos or pork factories operated in this. What you're talking about, which is possibly the next level of development, is, say, on stadium revenue, right? On perfume sales, securitization. These things are important, but Sharia has to acknowledge that these are compliant. So one of the areas that they're looking in Malaysia is cell phone airtime as a way of capturing that revenue and then basically issuing a bond of it. And they've done that. Right? So we today are limited by our imagination. Sharia working with investment bankers to produce these non-asset backed sukuk. And it's exciting because the opportunity coming from the Muslim world to build the debt capital market, to finance infrastructure, which basically address unemployment issues and have a multiplier effect. These are interesting developments that are taking, but again, it's a very slow managed process. If you're thinking from the point of view of can we do this like we do in the West, shelf registration efficiency, and then come to the market to take advantage of credit pricing, no, it takes a while. In Malaysia, we're getting close to shelf registration efficiency, where it's a few weeks. In the Gulf countries, it's a few months. So the process has started, but compression of the time frame to capture the efficiencies in capturing the credit pricing available, we're still a ways to go. This is part of that whole efficiency. The question that I often ask audience, what is the most valuable commodity in this world? Is it gold? Is it oil? Is it soft commodities? The answer is no, no, no. It's information. Most jurisdictions have laws against inside information. So information intermediation in Islamic finance and Muslim countries has to become conventionally efficient. If we can have information about Islamic finance that's conventionally efficient, much like a terminal, whether it's a Thomson Reuters terminal or its competitors, at the end of their fingertips. So users in Brazil or Kazakhstan or Benin or Canada just look at this as another asset class. Forget whatever you're calling it. It has got that information, it's got the workflow, it's got everything that you need to basically be a participant in this space. So from my point of view, the way we're going to go from 1.0, $1 trillion, 2.0, $2 trillion and beyond is basically having more participants. When you have more participants, they bring in liquidity. But liquidity requires information that's conventionally efficient. For me, you sort of have a vision of where you want to take it, and there's only so much you can do, right? You obviously need a great team, which I think I have, but you also need external shocks not to happen. You also need to have other stakeholders in this space do their thing, whether it's the scholars, whether it's the regulators, whether it's the academics, whether it's the banks, so on and so forth. So at one level, we are as strong as our weakest link. So that's something that all of us have acknowledged. For me, it's about information. It's not about product pushing. It's not about another scholar. It's not about another sukuk or another fund. Those things may contribute a little bit to the growth and development towards $2 trillion, but it's information. The Western markets grew exponentially because information was at the end of the fingertips for users to take financial advantage of it. Whether it's someone who's trading, whether it's someone investing, whether it's an entity or government raising money. It's information efficiency. If we can put that information on a platform, screen-based versus exchange-based, for the world to see, what you have is multiple price discovery, and where you have multiple price discovery, you've got multiple liquidity. You've got the ability to communicate with counterparties. People understand the counterparty risk. Then we're talking a good game.